on Business Incorporated today. Nigeria raises 1.25 billion euro bond. Kenya gets $750 million economic support from the World Health Organization. African Development Bank unveils $1 billion to boost wheat production. Hello and welcome to the program. It's the final one for the week. I'm Ini John Mekwa, and let's start as usual with numbers here in Africa. Looking at what's going on at intraday on the African continent, the NGX ACI was down 0.20%, while the JSE index in South Africa was up 0.62%. Egypt closed on Friday, but it ended Thursday session positive 0.19%, and Kenya also closed today. Ended yesterday on the red. Out of the African continent, its market pairs in the Middle East also closed on Friday. However, there are also markets which closed yesterday were mixed sentiment. The United Arab Emirates, Abu Dhabi and Dubai indexes dropped 0.01% and 1.26% accordingly. Elsewhere on the region, Saudi Arabia's Tadawul closed higher 0.89%, while Qatari index notched up 0.89%. Let's go to Europe now and see what's happening there. Oil prices pushed high on Friday, surpassing $109 a barrel as shares mainly retreated. Russia's invasion of Ukraine is causing the damage on financial markets. We have Ben Fezoli now joining us from Berlin. Hello, Ben. Well, the war in Ukraine seems to be on every trader's mind. In fact, not just traders. Is the market volatility here to stay? Does it look like that?
It sure is, at least for the time being. It's number one as far as risks go globally. And we're really seeing what sort of a role the Russian economy and Russia plays as a global player. Its economy is so important to the rest of the world. The oil and gas that it exports, the metals, the high-tech sector and supply chains have proved so important when it comes to Russia. So many goods are funneled through the country and jetted around the world on Russian planes. Russian tourism is also a huge money spinner for so many countries, especially in Asia. In Thailand, for example, we're seeing so many Russian tourists either not turning up for their holidays, of course, or stuck there. They're unable to take money out because of sanctions. Their flights have been cancelled and they're unable to return home in some cases. The Ukrainian economy has also proven so important over the past weeks. People have been discovering that it's the breadbasket of Europe and the world. It imports or exports rather so much wheat to Africa, to Asia, maize, sunflower oil alone. Half that supply to the world comes from Ukraine. And look at what's happening in the country. The UN says 780 civilians are now dead, over 3 million fleeing the country. That's going to hurt the economy. That's also putting pressure on other economies, taking on these refugees, and also other economies taking the knock-on effects, the economic effects at a time that the world economy is trying to recover from the global pandemic. So we're going to see a stalling of the global economy, and eventually it's going to lead to a recession at some stage. Russia's invasion is also stalling, according to British military intelligence and the Ukrainian armed forces. There are heavy losses that the Russians are enduring at the moment, and it sounds like this war is going to drag on and take much longer than Russian President Vladimir Putin had thought. It's not going to take just a couple days or weeks. We're seeing more sanctions from countries like Japan and Australia now, and we're also seeing peace talks, but they're not coming very far. The West says that it's a very, very big gap between Ukraine and Russia as far as trying to find peace goes.
Yeah, but it'd be interesting to know if those sanctions are actually getting or meeting the targets, that it was originally formed for.
Well, they're definitely hurting both sides. Russia more. It's becoming more and more isolated and eventually will become a very isolated economy and country. A lot of people won't want to do business with Russia anymore. But it's not stopping Vladimir Putin, that's for sure. He's used to sanctions and has had to deal with them for years now. This war in itself has been going on for 8 years. It's the invasion that's new, but the sanctions are nothing new to Mr. Putin. As far as how Russia is financing this war, we're seeing that Russia is managing to service its debt. Market sources say that some creditors have received payment of Russian bond coupons that fell due this week. That means they may have averted a debt default for now, but at some stage, if the country does default on its debt, we will see ripple effects around the globe.
All right, so the OECD estimates that the war could knock more than 1% of global growth this year. What are you hearing about this?
Well, Russia and Ukraine account for about 2% of the global economy, which doesn't sound like much, but they are extremely important, as I mentioned before, for the exporting of raw materials, of food and energy. And the OECD says that if sustained, if this impact is sustained on Russia, then we're going to see a deep recession within Russia, and B, inflation surging by 2.5% globally at a time that inflation is a real problem for the world economy. Consumer prices are rising. We're seeing that in so many countries. Interest rates are on the rise. We've seen that again in the US and the UK. And that's going to be a real shock to consumers and to businesses because both have enjoyed historic low interest rates for an historic long period of time. And that's going to hurt.
Yeah, sure will hurt. Ben, thank you so much for giving us that analysis. Well, moving on now, shares in Hong Kong slipped on Friday, but still finished the roller coaster week more than 4% higher. Hong Kong's Hang Seng Index swung between positive and negative territory, closing 0.41% lower, 21,412.40, but rising 4.17% for the week. In mainland China, the Shanghai Composite closed 1.12% higher at 3,251.07, while the Shenzhen Component advanced 0.32% to 12,328.65. Japanese stocks closed higher as the Nikkei 225 rose more than 0.5% to 26,827.43, while the Topix index climbed 0.54% to almost 2,000. South Korea's Kospi gained 0.46%, finishing the trading day at 2,707.02. The S&P and AX 200 in Australia climbed 0.6%, closing at 7,298.40. MTSI's Broadex Index of Asia-Pacific shares outside Japan dipped about 0.1%. In the United States, stock futures fell following a three-day rally for the S&P 500 that put the equity benchmark on pace for its biggest weekly gain in more than a year. Futures on the Dow Jones Industrial Average fell 174 points. S&P futures were down 0.73%, along with NASDAQ 100 futures. Shares of FedEx fell more than 3% in pre-market trading after the U.S. delivery firm posted a lower-than-expected quarterly profit amid labor shortages. Well, we have Mario Bird now to give us details of trading on Thursday.
The U.S. stock market rose on Thursday and rallied for its third straight day of gains. The S&P 500 is on its way to its largest weekly gains since late 2020. The numbers are telling us that it is clear that the stock market is on its way out. The S&P 500 on Thursday rose by 1.23%. The Dow Jones rose by 1.23% as well, and the NASDAQ increased by 1.33%. It is clear that investors are not concerned about the Ukraine-Russia war, as they believe that the U.S. stock market could continue gains despite the increase in pricing with crude oil.
Oh, thank you so much, Maria. Moving on to the global oil space now, prices extended their rally at the end of the third volatile week of trade after slim progress in peace talks between Russia and Ukraine raised the specter of tighter sanctions and a prolonged disruption to oil supply. Despite battleground setbacks and punitive sanctions by the West, Russian President Vladimir Putin has shown little sign of relenting. A fourth day of talks between Russia and Ukraine negotiators took place by video link, but the Kremlin said agreement had yet to be reached. Brent crude futures jumped $2.75 to $109.39 a barrel after surging nearly 9% yesterday. And that's the largest percent gain since mid-2020. U.S. West Texas Intermediate crude also futures climbed $2.93 to $105.91 a barrel, adding 8% jump from yesterday. Despite the rebound, both benchmark contracts were set to end the week down 3% after having traded in a $16 range. Prices have dropped from 14-year highs hit nearly 2 weeks ago. The supply crunch from sanctions on Russia and stuttering nuclear talks with Iran, dwindling oil stockpiles and worries about a surge of COVID-19 in China hit demand all drove the roller coaster ride over the week. And still in that space, Algiers have rejected an American request to increase gas supplies to Europe by reopening the Maghreb-Europe gas pipeline, which passes through Morocco. The 13.5 billion cubic meter Maghreb-Europe pipeline linking Algeria to Spain via Morocco was suspended in November last year when Algeria decided not to renew its contract with Morocco. That was because of major disagreements over the sensitive Western Sahara issue. Europe and the United States are asking alternatives to Russian gas and Algeria. If Algeria, which currently supplies the European Union with 11% of its gas needs, is opposed to reopening the Maghreb-Europe gas pipeline, which passes through Morocco, it could, however, increase its supplies to Italy by 10 billion metric tons per year. Meanwhile, in Nigeria, Bakers Association have been speaking on the spillover effect of the volatility in global oil space on their operations. Diesel, which is their main source of energy, is fully deregulated in Nigeria and has hit as high as 700 naira per litre. According to the president of Premium Bread Makers Association, Mr. Emmanuel Nora, they may have to shut down operations as their production cost as well as price of raw materials can hardly be captured in the pricing of their products.
Yeast that we used to buy for maybe 10,000 is now 20,300 naira. Milk, of course, that we used to buy for maybe 25, 29,000 is now 85,000 naira. Egg that we used to buy 800 naira is now 2,200 naira. So you can see that before now, in our costing elements and in our costing template, diesel is something that we do not even consider to be something that is too weighty, but now it is taking the place of even flour. So it's very, very tough for us as businesses. Right. We are hemorrhaging, and as I said, if care is not taken, the businesses will just run down, go under. And you know, as premium bread makers, we employ so many Nigerians in their millions, not only directly, but indirectly too. And then the distributors, men and women that come to our off-takers. Do you know the effect of their not being in business will cause and exacerbate the current situations we have in this country?
Well, moving on now, we go to the metals market. Gold eased on Friday and prices were set for their biggest weekly drop since late November as hopes for progress in Russia-Ukraine peace talks dented the metal safe haven appeal. Spot gold slipped 0.2% to $1,938.29 per ounce, while U.S. gold futures were down 0.3% to $1,937.30. The metal has fallen about 2.4% so far in the week. As concerns about the outlook for Ukraine ease, so did the gold price, and talks this week of the 15-point peace plan and potential for agreement between Russia and Ukraine has seen prices come off. Palladium rose 2.7% to $2,576.84 per ounce, was on course for a second consecutive weekly fall of about 8%. Spot silver was down 0.3% to $25.27 per ounce and set for its first weekly dip in 7 weeks. Platinum was flat at $1,021.62, but was set for a weekly dip of 5%. That's the biggest since November. We'll take a break now. When we come back, we have more African stories for you here on Business Incorporated in Channels Television. Do stay with us. Welcome back. You're still watching Business Incorporated on Channels Television. Well, the World Bank has approved $750 million of funding to Kenya to support an economic recovery from coronavirus pandemic and measures to improve government finances. Development Policy Operation Loan is set to help the East African nation enhance the performance of its domestic debt market, reform the electricity industry, and improve governance. It's the fourth time in 3 years that Kenya has tapped the DPU facility, bringing cumulative borrowing to $3.25 billion. But we have Matt Kindiga, practice lead, SSA Frontier Africa, elaborating on this and other issues as it concerns Kenya economy. Hey, Matt, good afternoon.
Hi, good afternoon. Thanks for having me on the show today.
Good to have you as usual. Well, what impact do you think this fund will have on the growth outlook of Kenya?
Well, certainly, I think it's a welcome development. In Kenya's budget speech in February this year, the government anticipated falling revenues, up until the middle of this year as a result of lingering effects from the COVID-19 pandemic. And this is because of, lingering effects of the COVID pandemic, but also because of weak agriculture production, which is undermining productivity and tax revenues from the agriculture sector. So this certainly is a welcome development. What we're seeing is over the last few months as well, the government has been forced to divert funding away from a recurrent expenditure and investment towards bailing out state-owned enterprises. Kenya Power, Kenya Airways, or part state-owned enterprise Kenya Airways was a good example of this over the last 6 months. So what this extra funding will do is allow the government to increase efficiency of public procurement procedures, as well as invest in infrastructure, specifically power sector infrastructure. So certainly this will provide a bit of a boost from a capital expenditure perspective. And it also crucially comes at an important time because this is an election year in Kenya. And we would expect the government to be tempted to raise spending on recurrent expenditure, for example, civil service wages, to increase its popularity ahead of the election. But the conditions attached with this extra funding does mean that the government will need to prioritize an element of capital expenditure. So certainly we do see it supporting the country's growth outlook to an extent.
Well, we can hardly have conversations about the economy otherwise at this time without talking about the war in Ukraine. And even the OECD has warned that growth rates would, be reduced. So how exposed is Kenya to Ukraine or to the war and the consequences thereof?
Yeah, certainly. So the Ukraine conflict has already driven up global commodity prices because of shortages of supply and concerns around the outcome of the conflict. Our view here at Frontier View is that commodity prices will remain high well into 2023 as a result of the conflict. And Kenya is particularly vulnerable to high commodity prices within the sub-Saharan African context. So it's much more vulnerable than a country like South Africa or Nigeria or Angola. And this is because although Kenya has a very open economy, it is very integrated into the global economy. So it is quite affected by investor sentiment or swings in investor sentiment and capital flows in and out of the country. It also doesn't export the commodities and metals that are really in demand at the moment and the ones that we're seeing very high prices for. So unlike South Africa, it doesn't export large volumes of iron ore or coal or gold or platinum. And so it's not going to benefit from high commodity prices. And at the same time, it imports large volumes of food and fuel. And so this will contribute to much higher inflationary pressure in the country. We expect inflation to average about 9 or 10% this year, which is substantially up from last year. And there's also likely to be much more downward pressure on the shilling. So we have revised down our forecasts for the shilling. It's much more likely to go beyond 120 and remain below that, 120 against the dollar for the rest of the year. We're also expected to see a slower recovery in European tourism because of the economic slowdown in Europe as a result of the Ukraine conflict. And Kenya is a big recipient normally of European tourists. So this will also affect the country's tourism industry.
And how do you expect central and fiscal policy to respond to these challenges you've noted?
Well, we are expecting there to be a bit of a shift in central bank policy and fiscal policy as a result of the slowdown. So previously, we were not expecting interest rates in Kenya to remain to rise very fast over the next year or so, and this is because we were expecting inflation to remain within the central bank's targets. Inflation to remain within the central bank's targets. Also, the currency was not expected to face significant downward pressure. This situation has changed, and we now are expecting the Central Bank of Kenya to raise interest rates a bit more aggressively. So this could raise the cost of borrowing as the central bank tries to support the value of the shilling and also contain inflationary pressures. We are also expecting to see some adjustments to tax and subsidy measures. So what we have seen, especially in North Africa, is governments responding by suspending import duties for food products, reducing fuel duties as well, and also providing extra subsidies for products where consumers are really struggling with the rising cost of living. So we're probably going to see a bit of a delay in some new tax increases and probably some short-term subsidies and maybe tax relief over the next couple of months. So certainly some changes in policy over the next few months expected.
All right, Matt, thank you so much for sharing your thoughts with us. Matt Kindiga is practice lead, SSA Frontier View. Thank you so much. Enjoy your weekend.
Thank you, too.
So in Nigeria, the country has raised $1.25 billion through the issuance of a 7-year Eurobond. The country has become the first African country to access the international capital market in 2022. The proceeds of the bond will be used to finance the budget and bridge infrastructural deficit. The offer was launched at an initial price of 8.75% per annum and on the back of strong investor demand. Nigeria was able to reverse the price guidance to 8.5% per annum. The order book continued to grow, reaching a peak of $4 billion. The timing of the deal surprised investors, given that yields are rising worldwide as the Fed raises interest rate and commodity price increases since the start of Russia's Ukraine war, threatening to increase inflation. While Nigeria stands to benefit from the rally in oil prices, as Africa's largest producer, it needs to raise money to close budget shortfalls that have been since the pandemic. Still in Nigeria, the Nuclear Regulatory Agency has opened bidding for the construction of a 4GW nuclear plant, which will provide close to 1/3 of Nigeria's installed generating capacity. The 4-reactor nuclear power plant will add a crucial 4GW of capacity to the country's energy supply and serve as a key initiative by the government to diversify its energy mix and ensure that energy security and address power outages. In partnership with Russia's State Atomic Energy Corporation, Rosatom, the Nigerian government had also planned to build 4 nuclear stations with a total cost of $80 billion, but that was in 2016. In addition, agreements were signed with Pakistan, France, South Korea to construct nuclear stations. However, none of the planned projects have thus far materialized, and the West African country continues to witness power outages. In Congo, IFC has begun work with the government of the Democratic Republic of Congo to bring clean solar energy to over 1.5 million homes, businesses, schools, and clinics in the country under the World Bank Group's Scaling Mini-Grid program. The SMG program was designed to help the DRC and other emerging countries establish public-private partnership mini-grids to bring low-cost renewable energy to consumers. And the African Development Bank says it is planning to raise $1 billion to boost wheat production on the continent to avert potential food shortages arising from Russia's invasion of Ukraine. The president of AfDB, Mr. Akinwumi Adesina, said that the fund will help 40 million African farmers utilize climate-resilient technologies and increase their outputs of heat-tolerant wheat varieties and other crops. He says that they're going to be really ramping up efforts to mobilize that money. According to him, wheat imports account for about 90% of Africa's $4 billion trade with Russia and nearly half of the continent's $4.5 billion trade with Ukraine. Well, that's it for the program today and for this week. But we'll do it again next week. Have a great weekend. I'm Ini John Mekwa.